Okay. More strategies. So stock selection, you can either use a top-down strategy. Remember me telling you in previous seminars, have some sort of an investing thesis and make sure everything conforms to it. So that's a top-down strategy. Bottom-up strategy is just independent stock picks that you think are going to do well. Um, Shorting stocks is uh, it's done differently at different brokerages. There's actually a short account in Qtrade. In others, you just put in a negative quantity. What shorting stock means is you believe that stock is going to go down, and so you kind of behind the scenes they lend you the stock that you think is going to go down. You immediately sell it, and then within X weeks, months, I've never done it, so I don't know. You need to give that stock back. So if you borrowed it at $100 a share, sold it $100 a share, and then it went down, and when you need to give it back, it's at 80, you've made 20 bucks because you can buy it at 80 and give it back to whoever the brokerage borrowed it from. Um, Problem is if the stock goes up, then you need to pay $130 a share, and then you're losing 30 bucks a share. So shorting is when you have a really good theory that the stock is going to go down.
Yeah,
Um,
it's a very risky strategy.
it is a very risky strategy
Yeah.
uh, because the stock could go up infinitely um, while if you're long a stock, it can only go to zero. So you're you're sort of limited in your losses. But if you're shorting, the stock could quadruple, go 10 times, and then you're in
Yeah.
serious.
Often short selling, Alex, is done in combination with limit orders, meaning that if you buy it at $100 and I mean, if everybody understands this concept is you're selling something without owning it. Right? You're literally asking your broker to lend you the stock itself. It's kind of like a loan, but it's not a cash loan. It's a stock loan, right? So you're borrowing a stock and then you're selling it without buying it. And then later on, you're hoping that the stock price drops and you buy it again to make a profit. But then to limit your losses, which you can do if you buy it at if you sell it at $100 and you're hoping it to go down, but it doesn't, you can put a limit order at $103. So that's the max, right? So if it goes to 103, you buy it and you return it. So you still have uh, a loss of $3 in it, but at least you don't have it more than that. You see what I
Yeah.
mean?
Yeah, so you can limit your losses that way. Obviously, you can set the limits to whatever you want. Uh, the stock could go up to 103. It could go up to 110, and then still drop back down to 90. So you don't know basically. Um, Anyways, so that's shorting. Nothing that I've ever done. Keep in mind with sort of an ever increasing market in the long run, the market goes up. You can get an individual stock and short it uh, if you feel strongly. There have been attempts out there to sling mud at various stocks in order to make their price go down. Like there's various companies that specialize in digging up dirt. So they basically establish a short position and then they'll release some damning news. I forget the one. Uh, anyway, it was some Herbalife uh, that like somebody's trying to make money. They're not just releasing news based on out of the goodness of their heart. So some exit strategies out of stocks. You can sell to prevent the losses, as we talked about. Sell when it's significantly appreciated in value or to fair value. So that's kind of your ideal case. The company got bought out by another company. So if that's what you were waiting for, if there was speculation that there was going to be a purchase, whenever a company is bought out by another company, the share, they usually sweeten the pot by giving you an extra 20% over the current share price. And immediately the share price jumps up to close to 20%. And then when the deal closes, then you either get cash or you get the other company's shares or a combination. And of course, it closes to or sorry, it the stock to be purchased jumps up to very close to what the offer is. And the reason why it doesn't jump to exactly what the offer is because there's some small chance that the deal will not go through. So you can sell it at that point as well. But that would be whenever there's a sale, you're like, yeah, because they usually have to give a little bit more. Or the company is bought by private equity for cash, in which case you just get money and you get out. What is pump and dump stocks? So that is a strategy by usually disreputable companies where they buy usually a penny stock and then they will release, whether on Twitter or various forums, stories where it's like, oh, this thing is going to double, triple, buy it now. If you believe the stories, you buy the price, you buy the stock that increases its price. That's when the company that did the pumping did all those releases of news and so on, and all the blogs and so on will sell the stock, so they make money. The stock price will drop, probably much lower than it was previously, and you're the one who gets screwed. So people on forums tend to be able to identify the pump and dumpers, but if you're new to it, yeah, be careful. It's usually small companies whose stock price is very volatile, and they'll release a news story saying, oh, we there's a rumor that they struck oil or whatever it is, and it goes up. Okay, options. I've gotten into options recently. They're very interesting. I don't expect you guys to understand them after this session. I just want you to be aware of their existence. So I'm going to go through this fairly quickly. Options are contracts, not legal contracts, but they can be bought and sold. And so this is the derivatives market. So if you ever read a prospectus for a mutual fund and it talked about derivatives or hedging, they're talking about options. So options come in two flavors, puts and calls. Thanks for your help, Girish, much appreciated. So puts is it's a contract giving the put owner the right to sell a security at a given price to the writer / seller, which is synonymous of the put. So I write the put, somebody buys it, they pay me money. I now have an obligation to buy what they want, the stock. These are all with stocks. The reason they're called derivatives is because they're sort of dependent on the price of the main stock. So there's two ways of, you can either buy them or you can sell them. So I can cover myself from a stock going down by buying puts. So I'll give you an example. Tesla went up to $1,000 a share. I really think it's overpriced. So, and I own it. I own it right now. And I think it's overpriced and I think it's going to go down. But just in case it doesn't go down, I still want to hold on to the stock to have share in the upside in case it goes up to 1200. But I'm worried it'll go down. So I'm gonna buy a put that I have a right to sell my Tesla stock to somebody for 900 bucks. So if Tesla tanks and it goes down to $800, I have the right to, because I paid for that put, I have the right to sell my Tesla shares for 900 bucks, even though it's now 800. My puts at this point also have the value of the 100, the 900 minus 800, because there is value in them thanks to that. Okay, so that's one way I can buy puts to cover myself, and this is where the word hedge fund comes from, is that they buy insurance. Now, if I want to purchase a stock at a cheaper price than it is now, I can sell puts. So I'll give you an example. Let's say I like BMO. It's now at, what was it, $76. I want to buy it at 70. So I'm going to sell a put and make a couple of percentage points. And I'm going to say, I'm going to buy your shares for 70 bucks. And somebody who currently owns it and wants to cover themselves from a drop will buy those puts. So I'm like, great. So if the price goes down to 70, I will exercise, or they will exercise the put. Or if it goes down to 69, and I have to buy it for 70. Okay. So these are kind of dependent on the stock price movement. If you know which way the stock is going to go, you can make lots of money. The reverse is a call. It's a contract giving the call owner the right to buy a security at a given price from the seller of the call. So let's say Tesla again, it's at $1,000. I'm like, I think it's going to go up. So I'm going to buy a call at 1100, and it'll cost me 3%, 4%, whatever the price happens to be. I don't have $1,000 on me, but I have $33 on me, or 50 bucks, or whatever the individual one's gonna be. So if I think it's gonna keep going up, I'm gonna buy the call, and I'm going to wait and cross my fingers that it actually goes up there. And if it goes past 1100, then my call ends up having additional value as well. But it's a way to control shares at a fraction of the price. Now, of course, if Tesla goes down, or it stays where it is, or it just goes up to 1,050, I'm not going to exercise them, because why would I pay $1,100 for something worth less than that? Now, you can also make extra money using something called covered call. So let's pretend you own a stock, you've owned it for a long time, and it's gone up a whole bunch. You're ready to sell it, and you say, okay, well, it's here now. If it goes up here, I wanna get out of it. So you sell a call, again, for a couple of percentage points. If the stock price does actually go up to it's called the strike price of the call, then somebody will buy your stock at that price, and you're out of it. You made the money that you wanted, plus you made the extra couple of percentage points from selling the call. So that's called a covered call, because you actually have the stock. When you buy the option, you have the right, but not the obligation. You paid the money, you bought the option, so if it's not in your favor, you're not going to exercise it. If you're writing or selling the option, then you're obligated because you got paid. The price of the option is determined by how close the option is to the current price of the stock. Uh, the option gets its value from being in the money when a call is below the current stock price and when a put is above the current stock price. So sorry if this is confusing. Um, if Tesla is 1,000 right now, and uh, I'm going to sell a call at 1,500, it's hardly worth anything because the odds of it hitting 1,500 are fairly close to zero. But the contracts, the options have an expiry, so you can have it like a month, 2 months, 3 months, and so on. So the further away you are from the expiry of the option, the higher its value, because there's more time for it to hit the target price of the option. And of course, the volatility of the stock price. So if something's really volatile, then there's a better chance that it'll hit uh, the price of the option. So it's used in hedging strategies, as we talked about. There's something called iron condor and collar, which I'm not going to get into at all. They're sort of cool cool things just to kind of know about. I've only dipped my toe in the water, so I'm not going to go any further about that. Any questions about this? Now everybody's shell shocked at this point. Okay, so order types in your brokerage account. So for buying and selling, you get to pick. There's a field where you pick an order type, and it'll be different for each brokerage. So market we talked about, you buy or sell at whatever the best available price is, and it could be dangerous in low volume. So when I'm going to buy or sell something, I select an order type. A limit, we talked about as well. It sets the maximum price that you're willing to pay for a buy or the minimum price you're willing to accept for a sell. So use these for low liquidity, thinly traded stocks. Hopefully I've explained that. You can do a stop limit or a trailing stop limit order, which becomes the limit order after the trigger price has been reached. So this would be when you want to protect yourself, you put in a stop limit. If the stock is going down, then after it reaches whatever price you're looking at, it says this is what I want to sell it for after it hits the trigger price. Stop market or trailing stop market will become a market order. So instead of being a limit order, it becomes a market order. So this is sort of a more desperate version, meaning when it hits the trigger price, just get out. Whatever the market will pay me, that's what I'm taking. So you can use percentages as well. So stock is going up, it hits its peak maybe multiple times, and then goes down a bit and then goes back up. If it hits the peak and then it goes down 20%, you can have it trigger these limits, these trailing stops, either market or limit versions. So that way it's all automated. It's already in the system. Yeah. Okay. These are just some macro events. We're kind of in the home stretch here. So if you took any macroeconomics, you'll probably be aware of these, but these are just some kind of general good knowledge kind of things. So interest rates affect the stock market. They're set by the central bank. Low interest rates to the positive will improve and speed up the economy because people are borrowing and spending because money is cheap. The money is cheaper, so companies invest in infrastructure, people spend more, and so they improve the revenues of the companies. Borrowing is cheaper, so lower interest rates go straight to the profits of the companies. They really help indebted companies like utilities, which paid for all those cell towers and pipelines, or anything with real estate, because that's probably a lot of borrowing there. To the downside, banks are harmed by lower spreads between the deposit rate and the loan rate. So low interest rates are generally not great for banks. And right now we're in really low interest rates. So banks probably got their shares beat up a little bit. And insurance companies will invest your premiums in safe vehicles, uh, which generally are interest bearing, and so they get lower returns. With high interest rates, the opposite happens. The economy slows down, but banks and insurance companies are happy. Wars and uncertainty, markets hate uncertainty. So if something unexpected happens, there's usually selling, or if the market doesn't know what's happening, there's going to be selling. Wholesale sell-off on a micro event are a great time to buy when people are panicking, and they'll sell something that has nothing to do with anything. Okay. We've had a few people drop off. Almost there. Oil goes up on uncertainty, so if there's a good war, oil will go up. War costs money, and they'll improve the economy. World War II is credited as getting the world out of the Great Depression, and of course, rebuilding also employs people and improves profits. Money is a real thing during war. Like you want efficiency. You don't want to pay more for a tank than you need to, because you're probably borrowing all the money. Sources of inspiration. So CNBC I watch, BNN I watch religiously. That's Canadian. CNBC is American. Stockchase.com is great for stocks, where they will type up, so like whoever runs the site will type up from BNN expert opinions. So I've listened to the actual broadcast and I looked at it on Stockchase, and it's a little open to interpretation, but generally fairly accurate. Like there's nobody who's misinterpreting it on purpose because they own the stock or something. At least I didn't see it. Morningstar.ca we talked about, and Yahoo Finance is also good. Magazines. So I pulled this out of Canadian Business many years ago. Please don't invest based on this. Valiant doesn't exist anymore. So what we talked about, so you got total returns, you got the dividend yield, you got the market cap, here's PE, price to sales, price to book. So these are all metrics very easily available. They'll give them a rating based on that, so you can use this as inspiration as far as what to go research. And I always like the Money Sense magazine, even though they don't really do individual stocks so much. Invest in what you know we talked about. Something where you have special insight. And that's it. All right. Thank you for sticking it out for, gosh, almost 2.5 hours. Any questions? Anybody want to ask? Are you all yeah, good. Did you guys kind of get everything?
I think it was beneficial for me to kind of know what the key things to look at. Obviously, I need to dive deeper into it and compare things, but I'm kind of starting off and gonna see where I get to. So I got to start somewhere.
Yeah. For those of you who haven't gotten in touch with me outside of the meetup, either find me on Facebook or LinkedIn. Like I said, I think everybody who's still left on the call will have access to me directly, or already has access to me directly. I'm always happy to chat. Do maybe on meetup.com sign up for one of the many investing clubs, if you want to call them that. You'll develop your own research methodology and kind of what you look for. Like Girish was looking at the cash flow quite extensively, probably more than me, but everybody has their own method, and as you invest, you'll kind of develop your own your own methodology and what works for you. Do consult the experts, but they're really only they only have an opinion, and they're wrong way too frequently. So, anyways, if you do enjoy doing the research, great. Pick maybe pick some bigger stocks, bigger companies to start off with. Build up a portfolio of something that's not going to be too volatile, and have that as an 80%. And then, then you can do the speculative stuff with the other 20%. I looked at my liquid assets, my investable assets, and half of it is in mutual funds and ETFs, and the other half is in stocks. The percentage you use is up to you. And so, yeah. Anyway, any other questions or?
Alex,
Yeah.
one question, and maybe it's too early to ask this. So I actually had asked Girish out of the Strategic Wealth group, and I sent him an email follow up, which you covered actually, that if I wanted to learn about or get into the stocks, but also, get into options at some point, is there a strategy that stocks first and options trading next, or there's no correlation, and while you're learning of stocks you could also start learning options? Is there level 1, level 2 kind of thing where you feel the complexity is too much, or it's just a different ball game and it doesn't matter? I just wanted to get your perspective on that.
Yeah, good question. So I would definitely start with stocks first.
Okay.
Learn the options as well. Options are sort of a shadow of what is happening with that stock.
Okay.
How can I put this? In some cases, you're sort of using the stock as a random number generator,
Mm-hmm.
and you're just sort of looking to get data points. And I've recently I've bought 3 covered calls. Now, in order to have a covered call, you have to have the stock first.
Mm-hmm.
So I bought a stock for $1.90, and I sold a covered call at $2, meaning if the stock goes up to $2, I lose the stock, which actually I would be more than okay with.
Mm-hmm.
If it goes to 210, the person who bought the call makes additional money, and I lose the stock. If the stock goes down, however, the call is not going to be exercised, and I have to keep the stock.
Right.
So, I mean, I can still sell it, but I mean, now I'm selling it at $1.60 or whatever it is. Before you can do options, you should be aware of stocks, and
Okay.
you should have an idea of which way that stock is heading. Because if the stock is going up, calls are going to be your vehicles. If the stock is going down, then puts are going to be your vehicles.
Okay, I get it. Got it.
Right?
Yeah, stocks. Got it. That's what I wanted to know. I didn't want to get into too much, but I wanted to understand and not just put everything in stocks or ETFs, and they could be more expensive. So that's why I was kind of getting a perspective. Got it.
The options, if you're selling them, you're making extra money. So there's ETFs and mutual funds out there which they'll buy stocks that pay dividends, and then they will also sell options to make a couple extra percentages. So there's all sorts of strategies. Do Google the Iron Condor, which will be absolutely fascinating, and the collar strategy with options. Options can be dangerous. Just with anything, if you don't know what you're doing, it's dangerous. So, but there's a lot of reading about it. Options is there's lots of training companies out there who will sell you a week-long course. One of my friends, this is VHS. You can see Optionetics at the top. So she bought a course for several $1,000s in order to make money using options, and then she said, "Yeah, I sort of play with them, but I don't think I really ever made any money." But yeah, it's a totally separate animal.
Okay.
Yeah, I think I've answered
So
your
you're
question.
saying start with something simple and then, yeah, I got it. Yeah, got it.
Yeah, yeah. I mean, in Canada, you have lots of options. You have lots of stocks that you can purchase that are basic and they're not going to go bankrupt. And if you're willing to buy in American dollars, there's way more choice out there as well.
Mm-hmm. Got it.